All right, guys. So I told you that we would go through these comprehensive problems in chapters 4, chapter 5. I was hoping to get it up earlier in the weekend, but unfortunately, life happens, and weekends, as you know, get busy, so I haven't been able to do that yet. However, you should be able to study using your books, notes, all that good stuff, without having to have absolutely had this review. But I'll get it up tonight. So let's start with chapter 4. We have the comprehensive review problem. Okay. So as you can see, we've got Blackbird Corporation. That's going to be us. We're going to be reviewing the entire accounting cycle. Here we have our balance sheet. How do we know it's a balance sheet? We got assets, we got liabilities, we got things like accumulated depreciation, our contra asset account, we have accounts payable, our liabilities account, we have common stock, we have retained earnings, so those are stockholders' equity accounts, right? So we know it's a balance sheet. So the first thing we need to note is that we are going to find our the number of shares outstanding, which is 4,810. We get that by dividing our common stock balance, 48,100, by the par value, or what the market, what we say we should be able to sell that for, not what we actually sell it for. We'll talk about par values in another chapter, but here we just divide that 48,100 by the 10, and that gives us 4,810 shares outstanding. Okay, so in this problem, we're going to purchase inventory to sell, and then we're going to turn around and we're going to sell to our customers. So we're going to be both the customer and the seller. So the first general entry we have is that we've received $3,570 in cash from customers in payment of account. Okay, so what's that mean? We're going to increase our cash by $3,570, and we're going to decrease our accounts receivable asset by $3,570. That is a net zero impact on the asset side of our equation, because we've increased an asset and decreased an asset by the same amount. Number 2, we have purchased merchandise on account from Blue Co. for $13,400. What does that mean? We've purchased on credit inventory. Okay, so we purchased $13,400 worth of inventory, and we told them, hey, we're going to pay you for this later. So we recorded that in an account to remind us to give them cash later. Okay. Number 3, we sold that merchandise on account for $15,700. The cost of that merchandise that we sold was $10,000. So what are we going to do here? We're going to make a single journal entry, right? So we're going to debit our AR because we sold it on account for $15,700. We're going to credit revenue to increase our revenue account because we've earned it, we've sold it. We're obviously in the sales industry, so when we make that sale, the retail industry, when we make that sale, we're going to immediately record that revenue, right? And then we are going to debit cost of goods sold. Again, this is an expense account. It is generally, when you are in retail, the most expensive expense account, the largest expense account that you're going to have. So we're going to debit that to increase it, and we are going to credit inventory and asset to decrease it by the amount that we sold. Okay. Again, this is the perpetual system of inventory. We'll talk about that in chapter 6. Because it's perpetual, the revenue and the cost side of the sale are recorded at the same time when we make the sale. Just like when we use up supplies, we will use up inventories, right, as we expense it out. So this is just, we are perpetually tracking what is in our inventory. We're not counting it periodically, right? We're not counting it at the end of the month saying, oh, we must have sold this. We're actually just tracking that each time we sell it. This will be in chapter 6. Number 4, we paid salaries of $2,170. And recall here it says paid. We paid those salaries, right? So that's cash. So we're going to debit an expense, and we're going to credit our asset cash. We paid Blue Co. in full. Recall that we got $13,400 in inventory from them, and we said, hey, we're going to pay you back later. That's what we're doing now. We are debiting that accounts payable account to show that we're decreasing it, and we are going to credit that cash account to show that we are also decreasing it because we are expending cash to pay that. We received collections in full from customers that we billed on December 17th. So that was the goods we supplied for $15,700 on credit. So we're going to debit our cash account, credit our accounts receivable account. Again, a net zero impact on assets. And number 7, we received $2,740 in cash from customers paying on their accounts that they owe us. So we're going to increase cash, decrease accounts receivable. All right, so now let's do a bank reconciliation. So Greene County Bank showed a balance of $25,970. We're going to compare this bank statement with the cash account, and it revealed the following facts for us. The bank collected $2,200 note receivable for Blackboard Co. on December 15th through electronic funds transfer. So that's that credit memo, right? And then on December 31st, receipts were deposited in a night deposit vault on December 31st. These deposits were reconciled by the bank in January, right? Okay, so look on page 33 of your blue book. That's journal entry number 7. Okay, these checks were outstanding. These were deposits in transit, right? And we had checks outstanding on December 31st totaling $1,250. On December 31st, the bank statement showed a non-sufficient funds charge for $700 for a check received by the company IOU, a customer. Okay. We're going to prepare a bank reconciliation as of December 31st based on the available information. Hint, the cash balance per books is $25,940. This can be proven by finding the balance in the cash account, looking at the beginning balance, and then posting the cash transactions above. Okay. So here is our cash T account, right? So that 12/1 debit of 19.5, that is our beginning balance. The 12/31 debit of 25,940, that is our ending balance. So anything on the left side or the debit side is an increased cash. Anything on the right side or the credit side is a decreased cash, correct? So 25,940, that is what we think the cash balance is going to be at the end of December. We have to reconcile our records with the books, our books with the bank statement to see what we truly have, right? So let's start with the cash balance per bank. What do we need to do? Well, fact number 2, we need to add those deposits in transit, right? That $2,740 that we were depositing in. We wanted it in December, but we got it there too late at night, and so they're not hitting the bank until January. It gives us a new subtotal of $28,710. Now we've got to reduce that amount by the outstanding checks, that $1,250, right? That was fact number 3. This gives us a new adjusted cash balance per the bank of $27,460, right? So you can see those are 2 transactions that we knew about that the bank didn't know about, right? So we have to adjust that bank statement balance, okay? So let's make some changes to our books. Do we think we're going to see those 2 on our books? No, we already made those, right? Those are original entries for us. Those are an increase and a decrease to cash already. So first thing we got is the EFT received for note, that credit memo from the bank. They collected $2,220 for us. Well, we didn't know about that yet. So we've got to increase our cash on the books for that amount. That gives us a new subtotal of $28,160, okay? Now we've got to reduce it by the NSF check that the bank told us about. That's that non-sufficient funds check. So we're going to reduce that by $700, which gives us a cash balance per the book adjusted of $27,460, which matches our bank. So we have reconciled our banks. Okay. Now we have to make some adjusting entries, right? We've done the reconciliation. Now we have to actually adjust the cash on our books. So what do we need to do? Well, we need to increase our cash and decrease that notes receivable. That's this entry right here, a debit to cash to increase it, a credit to the notes receivable to decrease it. And we need to credit an accounts receivable account. This is probably going to be a special AR account, right? Be AR for non-sufficient funds, something like that. AR for whoever's account wrote that check to us. And then we're going to decrease our cash because we never actually got that cash, okay? So some other adjusting entries. Well, we need to make that depreciation expense entry every month. So we're going to debit depreciation expense to increase it. We are going to credit accumulated depreciation to increase it as well. Okay. We had insurance that expired at $500. Essentially, think of this as you have used up $500 of your prepaid insurance asset. So we need to debit the insurance expense for $500 to recognize that $500 of that use of that asset has gone to help us generate revenues this month. Again, that is the matching principle, right? Then we're going to credit our prepaid insurance asset for $500 to decrease it. Now we have an income tax expense. It was unpaid at December 31st. This means we haven't paid it yet, but we need to recognize the expense, right? That's our matching principle, our expense recognition principle. We need to recognize that a portion of this income tax expense helped us to generate revenues this period. So we're going to debit an income tax expense account for $290 to increase it. We're going to credit an income taxes payable account to remind us, first of all, that we are going to have to pay some cash at some point for these income taxes, but not right now. So we are increasing that taxes payable account, which is a liability. Okay. Here is your adjusted trial balance. As you can see, everything balances at the end, your debits and your credits. Recall, this is going to be assets, right? Liabilities, revenues, expenses. Okay. Here's your income statement. There's a number from here that goes to the next statement, the retained earnings statement, right? That's your net income or loss. In this instance, thankfully, we had a net income. We also calculated our earnings per share, which is our net income, that $2,610 divided by that $4,810 that we did earlier on when we saw the balance sheet from the beginning of the period, right? So here's our retained earnings statement. Okay. This is our calculation. Beginning retained earnings plus net income less dividends equals retained earnings. We should know that by now. If you can break down the accounting equation, this should be somewhat familiar to you at this point. Or you can rearrange your accounting equation if you want. Total assets minus liabilities minus common stock equals your retained earnings. Okay. You can rearrange it. Personally, if I were you, I would just continue to take that fundamental accounting equation and break it down into its core components. So our retained earnings statement is going to look like this, right? Our beginning retained earnings, we're going to add our net income. It didn't tell us anywhere that we paid dividends, so that's all we've got. And we are going to get a new retained earnings number of $19,380. That is our ending retained earnings. We will be moving that to our balance sheet, right? Here's what our balance sheet looks like. We can see here the retained earnings. There is a note on there. It's got an asterisk by it. Just recall that comes from your retained earnings statement. It is always going to be your ending retained earnings. Okay. All right, that is it for chapter 4. Let's go ahead and hit up chapter 5 real quick and walk through this comprehensive problem. Okay. So we have a balance sheet at December 31st, year 6, that is presented here. You can see again, it's a balance sheet. We have assets, we have liabilities, we have stockholders' equity. All right, so again, we're going to take our common stock par value of $5. $20,000 divided by 5 is 4,000. That is how much common stock we have outstanding. Okay. We're going to prepare journal entries for the following transactions during year 7, January year 7. We use a perpetual inventory method. If you recall, we looked at that note briefly. It's going to be in chapter 6, but it just says, hey, when we make a sale, we are also going to record the cost of that sale at the same time. That helps us track our inventory in real time, as opposed to periodically going in and making a physical count of our inventory or whatever the case may be. Okay. So first thing we've got, we accepted a 4-month 8% note from Bird Company in payment of Bird's $1,200 account. So what's this mean? Well, now we've got a note receivable. It's got an 8% annual interest rate. Remember that. That's 8% annually, not 8% every 4 months, okay? So we're going to increase a receivable account, notes receivable, and we're going to decrease a receivable account, okay? So initially what's happened here is they said, hey, we're going to pay you in the next 30 days. They weren't able to, they said, so they said, instead of that, let's go ahead and just do a formal note. We'll pay you in the next 60 days, or excuse me, I guess here it gives us the actual terms. So it'd be the next 120 days at an 8% annual interest rate. Okay, so we're going to move that from an account to a note receivable. Recall the difference there is that the notes receivable are more formal, right? There's going to be terms to it as opposed to just, hey, pay us in 30 days. It's going to be, hey, pay us in $120 or 120 days at 8% annual interest rate. Okay. So we wrote off as uncollectible the accounts of Ring Corporation, $450, and Robin Company of $280, okay? So we're actually writing these off at this point. This isn't an estimation, we're actually writing these off. So allowance for doubtful accounts is a credit balance, right? Because it is a contra asset account. So we are going to debit it to decrease it by $450. We are going to credit accounts receivable to decrease it by $450. This is for Wren Company. We are doing the same thing for Robin Company in the amount of $280. Okay. We purchased $17,200 of inventory on account. This means that we have to pay somebody cash later. And in order to recognize that, we're going to create a liability account. That payable account tells us, hey, at some point in the future, we have to pay somebody. Okay. So since it's inventory, that's an asset for us. We're going to debit that, increase it by $17,200. We're going to credit an accounts payable account, that liability account that reminds us to pay somebody cash in the future. We are crediting that to increase it by $17,200. Okay. So we sold for $25,000 on account inventory that cost us $17,500. So that purchase we just made, now we're turning it around and we're selling it, right? So we sold it on account, which means we sold it on credit to a customer, right? So they haven't given us any cash yet. They've given us a promise that, hey, in the next 30 or 60 days, whatever, we're going to pay you that money. So we're going to increase that receivable account. That's the account that reminds us, hey, somebody owes us money. We're going to debit that to increase it by $25,000. We're going to credit sales revenue by $25,000. Apparently, we are in the retail business. Okay, so we're going to recognize that sale immediately. We're going to recognize that revenue immediately because we've made the sale. We've held up our end of the bargain. We've earned that revenue. We're also going to debit cost of goods sold, COGS. This is your biggest expense when you're in the sales industry, right? We're going to debit that to increase it by $17,500. That's what it tells us it costs to make that sale. And we are going to credit our inventory. We're going to reduce our inventory asset by $17,500. Okay. We also sold inventory that cost $700 to Redbird for $1,000. Redbird charged this amount on his Visa First Bank card. The service fee charged Hawk by First Bank is 3%. So basically this says anytime that somebody uses a bank card with us, we have to pay Visa 3% of that sale. Some of you met Jensen, my son. He was in class last week or the week before. He is currently behind me making some really weird noises, and I apologize. I have asked him to be quiet. Anyways, let's move forward here. So again, that just means out of that $1,000 that we think we're getting in cash, we're really only getting 97% of that, right? So we're going to make that calculation here. We're going to debit cash. We're going to multiply that times 0.97. So 1,000 times 0.97 equals $970. Okay, so that tells us that the expense, what it cost us to generate that money, was $30, which is that same $1,000 times 0.03 or 1,000 minus $970. Okay. We're going to credit sales revenue for the full amount because we're going to recognize that full $1,000 as revenue, right? And again, we're just going to make a perpetual entry here. This is the cost of goods sold debited for $700 to increase the expense and $700 credited to inventory to decrease that asset. Okay. So we collected from customers on account from 111. Okay. So we apparently gave them a sales discount, a 210 net 30 probably is what this looks like to me. So I left my blue book on my desk at school, so I can't actually see the problem until I pull it up here, but we're going to forge ahead. To me, it looks like it's 210 net 30 type sales discount. So what we actually received here was $24,500 in cash. We have to debit that sales discount allowance account to reduce our revenue. This is a contra revenue account, if you recall. So then we're going to credit accounts receivable to increase it by $25,000. Okay. Or excuse me, to decrease it by $25,000. Then we paid $16,300 on accounts payable. So this just means we've made a payment on that. We used cash. It says paid here. When you see the words paid, it means cash. Okay, so we're going to debit our accounts payable to reduce it by $16,300. We are going to credit cash to also reduce that asset by $16,300. Okay, so we received payment in full of $280 from Robin Company on the account written off on January 3rd. So we wrote that account off. They came back after we wrote it off and they made a payment to us. Okay, so what we need to do is we're going to have to, in the end, reverse that reverse that original entry. So we're going to put that money back into accounts receivable and say, hey, they still owe us. We'll pretend like it never happened. We're going to put that money back into the allowance for doubtful accounts so that another account can use it if we need to in the future. Then we are going to debit our cash to increase it, and we're going to credit the accounts receivable to decrease it by $280. Yes, those of you that are paying attention, and we discussed this in class, why would you debit and then credit accounts receivable for the same amount? It's a net zero effect. Well, again, this is accounting, so we're trying to tell the true full story, right? And this shows the full story of what actually happened. Okay, so we also purchased advertising supplies for $1,400 in cash. So this is an easy entry. We're going to debit an asset, supplies in this instance, to increase it. And we're going to credit cash because it says, well, it literally tells us we paid cash for it, okay? And then we paid some other operating expenses in the amount of $3,218. So we're going to debit our other operating expense account for $3,218. And we're going to credit cash for that same amount to decrease it by that amount. Why? Because it says paid. When we see the word paid, we know it's talking about cash. All right. So we could do just the revenue entry, right, for this 111 sale on account, okay? So we would increase our AR by $24,500. We would also increase our sales revenue by $24,500. In this instance, we are assuming they're going to take advantage of that discount, right? So we're recording it the net. This is that net method that we talked about in class, okay? This is just in the hopes that we don't have to make an adjusting entry later, okay? So if they collect it within, if we get to collect within that discount period, if they pay within that period, then we're going to do this. We're going to debit cash for $24,500. We're going to debit accounts receivable for $24,500. They took the discount, so just like we thought, so it's just a normal collection. If, however, they paid after the discount period was over, okay, they're going to have to pay cash for the full price, that $25,000. But what have we done? Well, we've got to add an additional $500 in revenue, right? Because now we've got that extra $500 that we didn't think we were going to get. Okay, so we're going to add that back to add back that $500 discount. And then we're going to credit AR for the $24,500 because that's what we debited their account in the AR subledger for. Okay, they're paying off their account, so we have to take out what they put in, right? Does that make sense? And see our debits match our credits, right? Okay. This is why we typically do the gross method in this class. It's just much easier. Okay. So we record interest for the month on the note from January 1st, right? So we have $8 in interest receivable. This is another receivable account. All this means is we know we're supposed to be getting this. We're going to get it in the future, but we need to record it now. We need to recognize it now, right? And then we're going to determine the revenue for it, which is very simple. It is your ART, your amount times time, times rate times time, right? So your 1,200 times 8% times 1/12 of a year, okay? So we expect our bad debt to be 6% of the January 31st, 2017 accounts receivable. So we are going to debit bad debt expense by $721. We are going to credit allowance for doubtful accounts by $721 as well, right? Again, this is a contra asset account, so we are increasing it by $721, so we need to recognize that expense, okay? This is the calculation for that. So if it's telling us 1,071 is what bad debts are expected to be, this means that we did not have that amount in our allowance for doubtful accounts. It looks like we had $351 or $350 there on January 31st. So we needed to increase that by $721 to get it up to our expected bad debt. And again, reminder, when we are using this allowance method, this is the only time you use the bad debt expense account. Okay. So account of advertising supplies on hand reveals that, or I'm just reading this too quickly. Account of advertising supplies on January 31st reveals that 560 remains unused, aka on hand, right? So it means that you have used, of your $1,400 you started with, you've used $840 of that. So we're going to debit that supplies expense by $840, right, to show that we used $840 worth of that asset to generate revenues. And we are going to credit supplies, that supplies account, that supplies asset account, to reduce it by $840 because we have used some of that up. So before we do the last adjusting entry, post the transactions we have done so far on the T accounts to help you find the new balances in those accounts, okay? Because now we're going to move those over, right? These are your check figures. Pause for a second, screenshot this, whatever you need to do to write these check figures down so that once you have completed your T accounts, you know that you match my numbers, right? Okay, so we're going to do an income tax calculation here, okay? So we had sales revenue of $26,000, COGS of $18,200. These are our other types of expenses. Okay, so we had total expenses of $23,509, total revenues of $26,008. So our balance, our income before taxes, is $2,499. We'll multiply that times the given 30% tax rate. That tells us that we will have an income tax of $750. Okay. Now, we need to record this expense and record the payable because we're not paying that right now, but we know that we're going to have to pay the cash in the future. We have to recognize that this income tax expense helped us to generate revenue in this period, right? In the period that we're accounting for. So again, that's just your matching, your recognition, your matching expense principle. So, got to record that expense. That's a debit. Got to record the payable just so that we know we owe somebody cash in the future. Okay, that is how you do the income tax calculation. Okay, here's your adjusted trial balance. As you can see at the bottom, we balance here. Okay, now we're going to work through our income statement. Okay, this is the multi-step income statement. This is the one you guys don't like because we're going to calculate gross profit and income from operations, and then income before taxes, income after taxes, all that good stuff. This is the lengthy one with more calculations, but it tells us more of the story, right? So we're going to take the cost of goods sold from our net sales. How do we get net sales? Well, that was our total sales revenue less any discounts that we applied. Okay, so that was that $500 when they paid us on time, right? It gives us net sales of $25,500. We reduce that by our cost of goods sold, which is $18,200, and it gives us a gross profit of $7,300. Okay, then we're going to calculate all of our operating expenses. Okay, then we're going to reduce that gross profit by our total operating expenses, that negative $4,809. Okay, that gives us income from operations of $2,491. Then we are going to go and get our other revenues and other expenses. Okay. All we have here is interest revenue. We don't have any other type expenses, so that gives us an income before taxes of $2,499. We calculated our income tax expense on the last couple slides ago, so we know that is $750. So we need to reduce our net income before taxes by $750. That gives us a new net income after taxes of $1,749. We divide that by $1,749 by the 4,000 shares of outstanding stock, and it gives us 44 cents earnings per share. Okay. So our net income number is going to come over to our new retained earnings statement. It didn't tell us anything about having to pay any, we didn't have to pay any dividends. So this is going to be a very simple retained earnings statement. Give us our beginning retained earnings of $12,730. We add our net income that we pulled from the income statement, and it gives us a new ending retained earnings as of January 31st of $14,479. Okay. Now, this is the balance sheet. Notice that our ending retained earnings, our new ending retained earnings is there at the bottom, $14,479. We can see that our total assets and our total liabilities and stockholders' equity are in balance, so our balance sheet is good. Okay, that is it for the comprehensive reviews. I know it's a bit of a long video, but hopefully it helps you guys. I will see you in class tomorrow.